So welcome to this lecture where we will now focus a little bit more on a conventional view on development, namely an idea of development that identifies development very much with the idea of economic growth, that is a growth of income of the people in an economy. And we will look at a particular class of models that try to rationalize how these growth processes actually take place. So if you compare that to the lecture we had before on the capability approach, we are now narrowing down our perspective to focus on the dynamics of changes in income, and thereby we obviously neglect many things that capability approach has highlighted. Still, I think it's relevant to have a view on growth models, simply because it is among the most influential ways of looking at development. And also because I think it can help us to understand one subset of development, namely the growth of incomes, in a much better way. So here's the outlook. I gave you this World Development Report as a reading for this session because it illustrates quite nicely how relevant models of economic growth are in practice. So our vantage point today is the recognition that growth is important for development, always taking into account that especially what we've learned about the capability approach should make us hesitant to identify growth with development. Still, I think it's an important aspect of it. And when we take this growth models perspective, we are asking questions such as which factors determine the growth rate of an economy? Is it maybe the level of investment? Is it the level of saving? Has it to do with the degree of marketization of the economy? And so on and so forth. We will ask the obvious question of why do countries' growth rates differ? Is it just because of the capital intensity of their economies, or might there be other reasons? And related to that, can we expect convergence? That is, can we expect all countries in the world to, in the end, converge to the same level of income? In all these cases, growth models highlight some aspects, but they also obscure others. This is one of the key elements of this lecture, so that you know that which tools highlight which aspects of a problem you might be interested in, but also to understand where these tools might obscure certain aspects. That is, where you might need to complement them with other tools you learned in different sessions. The outline for today is the following. We start with a short part about classical views of growth. About the arguments that classical economic writers in Europe have been making about growth and development, because this, I think, is important for setting the stage to understand what comes afterwards. We then, in the second part, we look at maybe the most famous growth model as of today, the Solo-Swan model. It's a very important model. It's rather simple. It excludes many things, but it has been the vantage point for basically all growth theory that has happening in the mainstream in the 20th and 21st century. So I think it's very important to understand what this model says, what it doesn't, how it works, and why it has become so famous. In the third part, we will look at what is called growth accounting. That is, it's an approach of decomposing the sources of economic growth. So to understand, okay, we have a certain growth rate in an economy. How much of that growth is due to capital accumulation? How much of this growth is due to increases in the labor force? How much of this growth is due to technological change, etc., etc.? And this is super important because it has been motivating what has been like the dominant view in the economic mainstream, namely the concept of endogenous growth theory. And because growth accounting has shown to be one source of growth to be particularly important, and endogenous growth theory actually tries to explain this exact source. And we'll see in a while what this source actually is. So we start our study of growth models by looking a little bit backwards to the period that is called often classical economics or classical political economy. In this period, there were a number of writers, European writers, that we will focus on that are usually called the economic classics. We are talking here about a period where economics as a separate science does not exist. We have basically a discipline of political economy, which has been closely integrated with the idea of ethics, political science, etc., etc. So as we will see, these writers usually have a broader view of the economy. And they are heavily influenced by the historical circumstances they are living in, but still they have been developing a lot of foundational ideas that persist until today. But before talking even about that, I would like to highlight again what we mean by growth. So today, growth usually refers to the real growth rate of national income. National income usually measured by GDP or one of a related indicator that you have been encountered before. GDP as such emerged in the mid of the 20th century. So in the 17th, 18th century, when the period we are talking about right now, GDP as measure as such did not exist yet. The first ideas of something similar to GDP have emerged in the 17th century by somebody called William Petty. He had an idea of basically measuring national income in a way that was very politically loaded. So he himself actually wanted to inflate the contribution to national income by workers because he wanted them to be taxed more, so that people like himself, landowners, actually taxed less. There are later important contributions by people who were less explicit about their political ambitions. Colin Clark actually is the one who developed the different kinds of how to measure GDP. Simon Kuznets, super important and influential empirical economist. He had a very different view of how to measure GDP that was much more aligned with a philosophical debate about what good life actually is. So what he has been writing on is very close actually to what we've encountered in the context of the capabilities approach. And he has been very influential in various areas of economics, but it was not his idea of GDP that actually is what we are looking at today. GDP as such has been heavily influenced by the idea of John Maynard Keynes, and an idea of the state as a central actor in economic activity. And that is basically the idea that is shaping GDP as of today. And given the important role GDP now plays in our political debates, it might be surprising that actually the first time it really came up as a political goal and wasn't GDP in the strict sense, it was the idea of the growth of national income, was in 1938, where Franklin D. Roosevelt in the elections of 1938 said that we must again start on a long, steady upward incline of national income. So what we often take for granted today emerged actually quite late in the 20th century. What's also important, so the idea of GDP as of today has been formalized basically after Second World War in the course of the Marshall Plan and all this. And this was a period where it was mostly a statistical issue. So people also, what Colin Clark, Sam Kuznets and the others were writing upon was, okay, how to actually account for national income. So it was very much about applied statistics and accounting. There wasn't really a theory of how this measure of GDP actually changes over time. There were some key contributions we're looking at in a second by Harrod and Omar in the 1930s, 40s. Some also cite Arthur Lewis as having one of the first growth models in there. We focus on what Trevor Swan and Robert Solow did in 1956, because that is often considered the most influential growth model. But as you see from the years in here is that the time where actually the measure it's all about, GDP, has been emerging, there hasn't been any growth theory yet. So when you look at these earlier contributions, you always need to take into account that these people were actually theorizing about something very, very new. But let's go even one step back. Look at what classical economics were writing about. And the interesting thing is, if you look at classical economics and growth, you see that all these writers didn't really talk about economic growth as such, but they were more concerned with capitalist dynamics as a whole. Their focus was less so on growth mechanisms, so what is driving economic growth, obviously, but rather they were focusing on what limits the development of their contemporaries and maybe how you could address these limits. Adam Smith, one of the most important economists of all time, obviously, he has written this book about the wealth of nations, actually his second important book. And in this book, he made the central claim that the wealth of nations basically is due to a clever division of labor. So the division of labor is actually what makes countries rich. But you can divide labor only insofar as you have a market that is big enough. Because if the market is too small, setting up a division of labor is actually not efficient. It's not cost effective, so don't do it. Still, division of labor is actually driving the wealth of nations. So all this is about a little bit about the size of the market. Smith has this very important example of the pin factory, where he says, okay, if you have one worker that just creates pins, he or she will be able to make 20 pins a day. So if you have 10 workers who are all working on pins, you will have about 200 pins a day being produced. But actually, if you divide work across workers and you have 10 workers and each person focusing on one particular aspect of making a pin, then you will have a vast improvement of productivity. The specialization on one particular step in producing the pins has a tremendous importance. So this kind of specialization drives productivity, according to Smith, and leads to this vast improvement that is actually underlying the wealth of nations, according to his view. And the fundamental limit to that is actually market size, because small markets do not support high specialization. But if you have a larger market, you will gain more from that specialization, and it's done more effectively. So for Smith, he wasn't talking about economic growth as such, but about capitalist dynamics and the development of it. And here, if you look at wealth of nations broadly conceived, it's the division of labor that's the key driver. And the key limit is market size. So it's mostly, or one very important aspect of it is extending the size of the market. David Ricardo is important for history of economic thought is hard to overestimate. He was basically almost a contemporary of Adam Smith. And he was, in his life, he was very concerned about whether the UK, where he was living, will be able to feed its growing population. Especially because the UK as such doesn't grow because the land that is available to the people to do agriculture in the UK is fixed. So the historical environment he's operating in is an environment where there was rapid population growth, where the prices for grain were increasing, and there were a lot of political debates about that, a lot of struggles of the people to actually get enough food for their families. Therefore, there was also this very important debate about corn laws, and corn laws were basically the idea of imposing tariffs on imported grain, and there was a huge debate in the UK about that, and David Ricardo was one of the most important figures in this debate. And in this context, he had this theory, which is probably the closest you get to something you could call a growth theory, that started with the idea that there is a fixed land supply in the UK. The UK as such, as a country, doesn't grow. So don't mind colonialism and all that, but he said he was focusing only on the land in the UK, and he said, okay, that's fixed. You can't make it bigger. It's fixed. And that is problematic because you also have a growing population. That means when you look at agriculture, and that was super important to feed the people at the moment, you're actually facing diminishing returns. Why do you face diminishing returns? Because if land supply is fixed, there are two things you can do. Either you can work on the land you have more intensively, and that is usually bad for the land in the mid or long run, or you can actually go to other places of land that are of less quality than the land you're using for agriculture right now. So you could, in your desperation of looking for new land, given that the overall land supply is fixed, you could use land for agriculture that you haven't used before because of its low quality. In both cases, that leads to diminishing returns and a decrease of agricultural productivity so agricultural output per worker. that has different implications, and that's one of the key contributions of David Ricardo, because he said, like, for landowners, that's actually good because they are benefiting from the scarcity of land. And they will be in a better position to actually to rent their land to others because they are more desperate to use it. So they will actually benefit from that, and they will incur rents. Rents being income where you don't need to work for, that you basically get for just owning something. Workers, on the other hand, they don't benefit from it. In his theory, he says that yes, the nominal wages of workers increase. Simply because of a growing population, also the grain prices increase. And for especially for capitalists who are hiring workers, that means they need to pay them higher wages because otherwise people will starve. But in real terms, workers have unchanged income. Their nominal wages increase, but so do the price they need to pay for their food. So in the end, there is no gain for them at all. And if you look at the capitalists, they need to pay these higher nominal wages to the workers for them not to starve, because if they starve, they can't work anymore. And at the same time, they face higher rents that they might need to pay for the landowners. So the capitalists are basically squeezed from two sides. And this, for David Ricardo, was a fundamental problem that leads to a stationary state, so to speak, of the overall economy. Because capitalists, in this context, they don't have any incentive to invest anymore, because they are facing no returns to their capital because of the higher nominal wages and the higher rents they need to pay. That, on the other hand, means that capital accumulation basically stops, and economic growth, if you want to say so, ceases. Capitalists do not buy new capital. They do not build up new things because there's simply no incentive. And that means in the end, in this stationary state, all surplus is captured by the landowners as rent. Now, this is something David Ricardo was very concerned about from a political perspective, but also from a scientific perspective, because it was very bad for the development of the society as a whole. So for David Ricardo, when he was looking at dynamics or growth, if we want to call it like that, it was fundamentally about studying how land limits growth or further development, and what kind of policies can help you to make the best out of this situation. And then there was Karl Marx, obviously, very important figure in the period of the classics. We will talk about him in more details later, but I think it's important to mention him here. For Karl Marx, there was something called expanded reproduction of capitalism that starts basically with the idea of exploitation. For Marx, you had two classes, capitalists and workers. Workers were doing work, and that's the source basically of all surplus value. And to do their work, they require capital. But the very defining feature of workers is their double freedom. They are free to sell their work, but they're also free of capital. So they are required to work on the capital that belongs to somebody else, namely the capitalists. And the thing that the capitalists are doing is they are hiring the workers to work using their capital, but they are paying them a loan that is lower than the overall value added. And they keep everything that goes above the subsistence level of the workers, they keep for themselves as surplus value. And this difference between the value of what workers produce and what they get as wages, this difference has led Karl Marx to use the term exploitation of workers. So the surplus that capitalists get by exploiting the workers, they usually don't use for their personal gain. This has been something that kings have been doing before capitalism. But capitalists cannot do so. They need to reinvest the surplus value into more capital to foster capital accumulation, because if they didn't do so, other capitalists would do that, and they would basically throw them out of the market by being more productive. And this has led to this capitalist expansion, more and more capital accumulation. Now, what Marx was highlighting and here it becomes important when we talk about development and growth, is that there is an internal contradiction of capitalism. And this is different to, for example, what Smith and Ricardo were talking about, where this limit to development or growth has come from the outside, the size of the market, the supply of land. But Marx was referring to something else, something that is internal to capitalism, so system inherent, so to speak. Because he said, okay, there's this competition among capitalists that enforces them to buy more and more capital, to basically mechanize their whole line of production, to become more efficient and thereby keep up with the other capitalists. That, on the other hand, leads to the economy to become more capital intensive. I will provide you with a sheet where you see some formulas that basically formalize the whole argument, but it basically means that the share of variable capital increases. So the economy becomes more and more capital intensive simply because capitalists are forced to make their production more capital intensive and to buy more capital in order to keep up with others. But that, on the other hand, leads to a falling rate of profit. Because if you have more and more capital, then the overall profit of what remains in the end for you goes down. And this hypothesis of the falling rate of profit has been super important for Karl Marx. Because he said, in the end, this falling rate of profit leads to a situation where capitalists don't have any profits to reinvest anymore. There are counter movements, such as exploiting workers even more. There are also other implications, but in the end, this falling rate of profit will lead to a fundamental crisis. Because it leads to declining investment, it leads to stagnation because there's no profits to reinvest anymore. It intensifies the competition, it increases the exploitation, such that capitalists in the short term may keep the profit more or less stable, but in the long term they can't hold that for long. It also leads to imperialism, where the imperialist centers or capitalist centers try to colonize other areas of the world in order to keep up the rate of profit. But that in the end then also leads to conflict between the colonizers, leads to war, leads to even more and brutal exploitation. In the end, it will lead to a system-wide crisis, because this falling rate of profit can be slowed down, but you can't get rid of it. This is why Karl Marx said, in the end, there will be a revolution and capitalism will cease to exist. And thereby, you also see, while not going too much into the details, as we have a separate session on Karl Marx, for Marx, there has been an internal limit to capitalist expansion, aka growth. And this has been internal to capitalism. So if we summarize what the classical economists said about growth and development and how they thought about it, is we see that all of them were not, they didn't use the term growth. They were concerned more with systemic or societal dynamics as a whole. There was no growth theory in the contemporary sense, most of all because this broader view in society where they didn't make this clear distinction between economic and non-economic factors. Especially Smith, but also Smith and especially Ricardo, they focused on external limits. Smith, size of the market; Ricardo, scarcity of lands. These are things that are basically not internal to capitalism, but it's a situation capitalism is facing. Karl Marx, on the other hand, with his focus on the falling rate of profits, highlights internal contradictions of capitalism and an inevitable decline of that system. What all three of them highlight, however, are distributional conflicts of growth and developments. This was most explicit in what Ricardo was writing about, where he said, okay, the scarcity of land in the end has different implications for landowners, workers, and capitalists. Also, Marx, you see the conflict between workers and capitalists, but also the competition among capitalists. Technology, for example, more effective ways of using land. If anything, it was considered a problem solver for Smith and Ricardo. Smith, very optimistic about different technologies that facilitate division of labor, Ricardo, okay, more effective ways of using land. For Karl Marx, technology was not something special. It was something that was basically endogenous to the class conflict. If anything, it was a source of further problems, but it wasn't something that could address this internal contradiction of capitalism at all. And this also relates to the implication. Yeah? Smith and Ricardo, they focused on limits. Especially Ricardo was quite pessimistic with his view on stagnation of the capitalist system. I mean, he was wrong for some reasons, but still his theory has been influential as of today. Karl Marx went much further than them. He said basically capitalism contains its own seed of destruction, so to speak. So capitalism endogenously goes to its own destruction. Well, people have different opinions on whether this is actually a wrong prediction, and Marx was wrong in all senses. While others say, okay, basically he was right. It was just a claim more long-termish than short-term, and actually we will face that situation in some point in the future. We will talk about that at a later point of time. The main point is here that the classical economists, they didn't have a growth theory in the proper sense. They were focusing mostly on limits to growth and development, if you might say so. That is different today.